So the global carbon market is going through this massive transformation, right? It's shifting from being just a niche tool to a full-blown multi-billion-dollar asset class. But here's the paradox, and it's a big one. Trillions of dollars are getting ready to pour into this market, but the actual infrastructure holding it all up, well, it's fundamentally broken. It's like building a skyscraper on a foundation of sand.
All right, let's really get into this. To see just how deep this disconnect goes, you only have to look at the numbers. It's a tale of two completely different prices. In the spot market right now, the average price for a carbon credit is sitting at around, $5.60? But in the forward markets, you've got major corporations signing these big offtake agreements for future carbon removals at an average price of $180. Think about that for a second. That's a 30 times difference.
So what on earth is going on here? How can this massive valuation gap exist in what's supposed to be a single cohesive market? Let me be clear. This isn't just some weird pricing anomaly. No, it's a giant red flag. It's signaling a deep, fundamental flaw in the very architecture of the market itself.
So, here's our game plan. We're going to break down how carbon is becoming this new asset class, really dig into the market's structural flaws, and then talk about the intelligence layer that's needed to build a modern, functioning climate market. Okay, first things first. We really need to get our heads around a fundamental shift that's already taking place. You see, carbon isn't just a simple compliance tool anymore. It's evolving into something way more complex, way more strategic. Look, for any sophisticated investor out there, carbon credits are now serious financial tools. We're seeing them used to diversify portfolios, mainly because they have a low correlation with traditional assets. They're being used as a hedge against both inflation and, crucially, regulatory risk. And, of course, they've become the primary vehicle for allocating capital towards credible net zero strategies. This is a whole new ballgame. And hey, this isn't just some theory. The numbers, they're absolutely staggering. Get this, $43 billion. That's how much institutional capital has been committed to carbon credit activities in just the last few years. We're not talking about sideline money here. This is core allocation strategy coming from the world's biggest asset managers. The smart money is already moving in.
But, and this is the huge but, this quote just nails the core problem. All of this capital is flooding into a market that completely lacks the basic infrastructure that we just take for granted in literally every other asset class. It's a 21st century financial instrument trying to run on 20th century fragmented systems. It just doesn't work. So, this brings us right to the heart of the issue, the deep structural flaws that define the carbon market today. This is all about the massive disconnect between what this market wants to be and what it actually is.
And we can break these down into 5 key inefficiencies. First, pricing is totally opaque. It's a black box. Then there's massive confusion over what quality even means. The regulatory landscape, it's a patchwork quilt. Liquidity is scattered all over the place. And to top it all off, the data you need is almost always late. So just imagine, you're a pension fund trying to build a carbon portfolio. You have no single place to get reliable pricing. How can you possibly assess your risk? You can't.
Now, what's really interesting is that the market is trying to price for quality. It knows it has to. If you look here, you can see that higher rated projects, think afforestation, reforestation, what we call ARR, they get a much higher price than older projects that just focus on avoiding deforestation or READY+. And then you've got the forward contracts for really high durability carbon removal, CDR, and those are priced way, way higher. So the market gets it. It knows quality matters. It just doesn't have the right tools to price that quality efficiently or consistently. And one of the biggest risks that the market is trying to price in is this idea of additionality. Now, this is the bedrock of a credit's entire value. It's the simple question: would this project's climate impact have happened anyway without the carbon financing? Because if the answer is yes, if that gets disproven, the credit's value goes to zero. Poof, it becomes worthless overnight. So when you put all these flaws together, the consequence is simple, and it's severe: systemic mispricing. And let's be crystal clear, where there's mispricing, there is massive, unquantified risk. And that risk is attached to the billions of dollars that are already flowing into the system.
But you know what? That risk is exactly the catalyst the market needs. It's forcing the entire system to professionalize, to grow up. The sheer scale of institutional money Plus, a whole new wave of regulation is creating this undeniable, urgent demand for real market intelligence. Corporations today are operating under a totally new mandate. They have to disclose their emissions under new standards like IFRS S2. They have to comply with carbon border taxes. They have to align with integrity frameworks like the core carbon principles, if only to manage their own reputational risk. The days of guesswork are over. It's just not an option anymore. And that institutional capital, it comes with a non-negotiable list of requirements before it can really be deployed at scale. It needs transparent, investor-grade data. It demands sophisticated tools for modeling risk and for forecasting. And it absolutely requires portfolio architecture that lets you run scenario simulations. Look, these are just the table stakes in any other mature financial market. So that brings us to the solution. And it's not like we have to reinvent the wheel here. To figure out where carbon markets need to go, we can just look at how every single other mature asset class solved these exact same problems of opacity and risk. I mean, just look at this comparison. On one side, you have mature asset classes like equities or FX. They run on centralized data terminals, standardized indices, and powerful risk engines. And then you have the carbon market today, running on fragmented registries, opaque over-the-counter pricing, and silo data. That right there, that is the infrastructure gap, and it has to be closed. So here's the bottom line, the most crucial point of all of this. Every single mature asset class in history is built on top of an intelligence layer, a system that gives you the data, the analytics, the risk tools you need for capital to flow with confidence. Carbon is no different. It absolutely needs its own. And this really changes how we have to think about the future. The next chapter for this entire asset class will be defined by just one thing: data. Market intelligence is the key that is going to unlock the full potential of climate finance over the next decade. Think about it. The next phase of this market is not going to be about just buying a bunch of credits and crossing your fingers, hoping their value goes up. No, the winners will be the ones who have the superior data, the ones who can understand complex regulatory flows, who can actually model project-level risk, and who can build sophisticated portfolios based on real analytics. The future of this market will reward intelligence, not just blind speculation. Which leads us to the final piece of this puzzle, actually building that institutional-grade infrastructure. It all comes down to creating true intelligence for climate markets. And we're not talking about a tool for just one type of user. This intelligence layer is absolutely critical for everyone who has skin in the game. Brokers executing trades, climate funds that are allocating capital, corporations trying to manage their net zero pathways, and of course, asset managers building out new climate-focused products. This is exactly where an intelligence terminal, like the one from CRBN.credit, comes into the picture. Just think about how its features directly address those structural flaws we talked about. Curated portfolios, they help diversify that single project risk. Third-party verification, that gives you independent quality assurance. A blockchain-based ledger provides a transparent, unchangeable audit trail. And institutional-grade analytics, well, that's what enables a truly data-driven strategy. Look, if carbon is truly becoming a financial asset class, then it's non-negotiable. It needs financial-grade infrastructure. The entire goal here is to bring that level of intelligence to the climate markets. You can see what this looks like at CRBN.credit. So the evolution of the carbon economy, that's a done deal. It's happening. The real question now is whether the intelligence layer that's required to support it can evolve fast enough to actually meet this moment. That's the challenge ahead. Thanks for joining us.